Good evening, students. We went through the pre-scene of December 2021 paper. So we analyzed the case and then we understood the background of the case and the possible issues, and some of the calculation we looked at and what are concerns the case has also we discussed. Moving from there to the unseen question. So question number 3, you could have gone through or you can go through that question. So they say like there are 2 board meetings the company has held to discuss on the aspects of IOSL. IOSL is the company Rayan's started, and now Rayan is sick, so he wants to sell the company to the main company, the family owned company. So IOSL is informing the parties concerned that IOSL financial information is to be analyzed, and then we have to look at what's the value we should be looking at it for the IOSL. So the board meeting 1, if you go through, the question says that in order to establish a value for IOSL, there are various aspects or the factors they are given for us to make the comments or maybe to make the adjustments to calculate the value of the company. So you could see that factors to be considered when normalizing earning before interest and tax, taking 2020-21 as the benchmark year. So 2021 has been given in your pre-scene. So you could see that in your pre-scene material, IOSL information is given there. As an annexure. So you can see the IOSL company P&L given for 2020 and 21. You can see there the profit for the year last year was 7,082,000, and you have been given a balance sheet for IOSL. You can see 31st March 2021, and the shareholder funds remains to be 137 million. So that's given in the pre-scene. That had been given in the pre-scene. So the unseen material talks about certain adjustments you need to look at in order to normalize or maybe to get the kind of a recurrent profit of the company. They have given you information. So countrywide lockdown, if you take the information, countrywide lockdown brought down the sales level to 80% in 2021. So the 2021 is the financial we have been given. So as you know that March 2020 we started having the COVID impact in Sri Lanka. So definitely 2021 is the year which got affected by the COVID. So they say the sales for IOSL had been 80% of it should be. So the lockdown had brought down the sales to 80% of the sales which could have been there. However, the full capacity of sales is expected to recover and continue with a gross profit margin of 33.5%. So the sales is expected in 21-22 is on a normal 100% capacity, and 33.5% GP margin you could expect. So that's one of the adjustment or maybe the consideration you should make in terms of forecasting your future. Selling and distribution expenses for the year 2021 included e-commerce related expenditure of 10 million. So it's a capital nature, which is one of expenses, 10 million rupees, and the impairment charge of trade and other receivable 2021 will be 1 million. So even though the amount given in the P&L could be different, but it's 1 million will be the impairment cost. Then a normalized EBIT for the next 10 years would increase at 3% per annum. So it's a growth rate of your EBIT of 3%. You may ignore any terminal value beyond 10 years. So generally we have a number of years of future we forecast, and after a point we take the terminal value, but in this case the terminal value you have been asked to ignore. The effective tax rate is 28%. If you could recall, when we were doing the pre-scene discussion, I said the tax rate could be 24% and we calculated the numbers. On the calculation of the cost of equity, we use 24% as the tax rate, but in this case they have given you the tax rate for IOSL is 28%, IOSL 28%. Then a depreciation cost is given as 25 million for the next 10 years. Working capital requirement is currently 28.57, which would increase at 5% per annum for the next 10 years. It's about 10-year period they are talking about IOSL valuation. Capital expenditure is estimated to 22 million for next 10 years. So you have working capital, depreciation, capital expenditure, all three information. So whenever you read this kind of information, you know that question is going to be asked on the free cash flow based valuation, Then they say it has been the practice of the company to use the short term borrowings to meet the long term needs. So short term borrowing is also using for long term needs, so it's becoming your part of your capital structure. Even though short term borrowing, it's also considered to be part of your long term capital. That's why you need to be considering in your gearing calculation later on. This was the direction given by Regan with a view of settling them when there was extra liquidity. So whenever there is a short term borrowing you have, they see there is excess cash flows, they will use that to settle the outstanding liability. Then they have taken the effective annual interest cost of the short term borrowing is 9%, so that's your cost of debt, 9%. Then if it is decided to liquidate IOSL immediately, so the earlier information what we discussed or looked at are mainly for your free cash flow based valuation. But if you take the point number 5, in case you are going to go for liquidation of the IOSL immediately, the property plant equipment could be realized 20 million above their book value. So whatever the book value you see in pre-scene will be getting additional 20 million as the value creation, right? While intangible assets and right of use assets will have zero value. So whatever you have right of use assets and the intangible assets in your balance sheet will not have any value. Other investments and current assets except for cash and equivalents could be realized only at 80%. So you need to understand that out of your other assets and the other investments other than cash and cash equivalents could be realized only 80%. So cash and cash equivalents, you know, definitely is 100% recovery, but other assets will be recovering at 80%. Total liability will be settled at 80 million and the liquidation cost of the company will be 20 million. So this is actually the information given in terms of you calculating the value of IOSL on the liquidation basis. If you are going for liquidation of the company, what would be the adjustment you would need, that's basically given in point 5. Okay. Then the board meeting 2, I will come to the board meeting 2 later. So we will go to the question A part. Required 17 marks, A part of the question. It says that Albert has received a valuation summary carried out by his finance team for IOSL equity shares. So it's about IOSL. Now, we were talking about EOSL at the pre-scene level, even though IOSL was just information about Revan's company, but we didn't go into detail in discussing that. But now the 17 marks question is about IOSL. They say that company Albert has received valuation summary carried out by his finance team for IOSL equity shares. Surprisingly, the values have ranged from 42 million to 452 million based on various valuation methods. So they themselves agree that there are 4 or many methods of valuation they have used to value IOSL, and the value you get is starting from 42 million to 452 million. So the range of your values is 42 to 452 million. Validate the price range under 4 valuation method with necessary assumption. So there, if you have got your value of IOSL, different methods are given different value. So we need to now validate to show that how this 42 to 452 million had arrived at. Okay, 17 marks question. So you have been asked to, it's not about just asking you to calculate value. They say validate. In the case of this question, they have done the valuation, they have got the answers. Now your duty is to ensure that your value, what you calculate using different methods, are basically falling into the range of these four valuation methods, 42 million to 452 million. So 17 marks, and the assumption whatever you make in the process of calculating has to be mentioned. So when you go to the suggested solutions, so the four methods they are going to use or they have used in the suggested answer, one is the PE method valuation. Obviously you know that PE had been given in your pre-seen material as 6 times. So PE is given, so definitely we can use the PE method to value the company. 1, earning based valuation. Then we can use our net asset based valuation, that's asset based valuation, because you are being given a balance sheet, net assets, so you can use the net asset based valuation to find out what are the net assets. So as you know, the net asset based valuation is the least value you generally get in any valuation, because it does not look at the future cash flows, future earnings and the potential of the company. So net asset basis, even though we use and calculate the value, it may not be the appropriate value for any company. So we will use the second base, asset base. Third one, in this question they have given you, apart from your net asset basis, they have given you, in case you go for a liquidation, what would be the value of your company. So that is the liquidation basis, or maybe the you are basically kind of selling the assets one by one and settling your liability. So what's the value you would get in that process. So that's the third way you can use the valuation in this case. Fourth one is the more comprehensive method of valuation, discounted cash flow or the free cash flow based valuation. So as you know that based on your theoretical knowledge, out of the 4 methods, obviously discounted cash flow method is the more comprehensive method of valuation, because it looks at the future cash flows, it looks at the future potential of the company, and it is more appropriate, and generally it is supposed to give you the higher value compared to other methods. Net asset based valuation, we know that based on the balance sheet historical basis, so it may not give you the right value or maybe the appropriate value for any company. Liquidation basis, it's something which is asked in this question. It is actually you are going beyond that, where you say that you don't have future of this company, you just sell the assets and realize the value and settle the liability, and still how much you get it for shareholder balance money. And income base, it's a PE method of valuation which generally used provided your company reflecting the proper earning. If it is properly reflecting the earnings, your value will be a good value for the company. Otherwise, it will give you a lower value, right? So we will look at now one by one the methods. First one, income based. As you know that PE has been given in the pre-seen material, this industry, the PE ratio of the industry is 6 times. So we also can use the same PE ratio to value the company. 1.76 is the earning per share, and IOSL P&L, if you look at IOSL P&L what I showed you earlier under pre-seen, 1.76 is earning per share. So 6 into 1.76 is the market price per share, 10.56. So you know that under PE method of valuation, PE equals to market price per share divided by earning per share will give you the PE ratio. So here the PE ratio is given and your earning per share is known, so automatically you know how much the market price is, that is 10.56. Number of shares as per the balance sheet of IOSL in the pre-seen. If you want to look at the pre-seen IOSL, pre-seen of the IOSL company balance sheet, you can see stated capital is 40,250,000. So it's a 10 rupee shares, so you are talking about fund 4 million, you are talking about 4,025,000 shares. So 4,025,000 shares, market price 10 rupee and 56, so your value will be 42.5 million. So first method of valuation we are using to validate is 42.5 million. So as a question asks you, your table of summary or valuation what they are calculated as 4 values or the 4 methods that start from 42.5 million to 452 million. So the first one, income based valuation, when we do the validation, we get 42.5 million. So that is correct. Second, asset based valuation, as I mentioned earlier in the preceding IUSL balance sheet, it is 138 million. Purely based on the balance sheet, you can see 138 million. If you want to look at a common pre-scene, 138 million is here in your shareholder funds. In your balance sheet, just looking at the balance sheet, 138 million is there. So that is the second method of valuation. So you can see that net asset based valuation, you get 138 million. That is the working number 2. That's simply your balance sheet, pre-scene IUSL balance sheet value. Third one is your liquidation basis. As I mentioned, they have given you another method of valuation, or not it's actually method of valuation. You are asked to calculate the value considering the company going for liquidation. So if you are looking at the company going for liquidation, we take asset by asset. PPE, your balance sheet value is 66.8 million. That they say is when you go for liquidation, you get 20 million more than your book value. So you are talking about 86.8 million, you are going to get value realization on PPE. Then moving on to the other assets in your balance sheet. PPE, we took 66 million. Intangible assets and right of use assets. In the question they say when you are going for liquidation, there is no value for intangible assets and right of use assets. So these two assets, even though in your balance sheet you have value at this moment, but when you are going for liquidation, you don't have any value for these two assets, intangible assets and right of use assets. But you will have value for your other investments and your current assets. Only thing, other than the cash and cash equivalents, all other investments and the inventory and trade receivable, which are other assets, all will have value, not 100%, 80% of the value. So when you go to the suggested solution, you can see other investment balance sheet value, inventory value and trade and other receivable value. All three values, if you are going to realize 100%, you can just add these three together. But you get only 80% realization of total, which is 215 million. So only 80% of your other investments, inventory and trade and other receivable you are going to realize. That will give you 215 million only. Cash and cash equivalent 10.7 million. Obviously you should get 100% recovery because those are the realizable value of the cash and cash equivalent. Then you get 312.5 million. So 312.5 million is the total asset realization, what the proceeds you get. From that you are going to settle the liability. They have given you the liability value going to be 180 million. So you settle that 180 million from your realization, and there is a liquidation cost because you are going for liquidation process. There is a cost involved of 20 million. That gives you 112 million. So net proceeds you are going to get is 112 million. So this is under liquidation basis. Please understand, on the liquidation basis, you are not going to get the same value in your balance sheet. You are not going to get the same value in your balance sheet. You will get PPE 20 million more than what you have in your balance sheet. Intangible assets and the right of use assets are not going to get any value when you are going for liquidation. So you don't have you have only zero value. But your other investments and other assets will be getting 80% realization of your value. So 268 your balance sheet value, 80% of that is 215 million. Then you get cash and cash equivalent. Cash and cash equivalents, you will get 100% recovery, that is 10.7 million. So altogether you get 312 million, 12.5 million. From that you settle your liabilities, which is 180 million. Then minus your liquidation cost 20 million. So net proceeds you are going to get 112 million. So the third method of valuation we are looking at is the liquidation basis 112 million. So we go back. You can see that out of 4 methods, income base gives you 42.5 million, asset base or net asset base gives you 138 million, liquidation base gives you 112 million. So these are 3 values you have got under 3 methods. Then we go into the comprehensive method of valuation. Obviously it will take longer time, and it's the value which gives you the more comprehensive method of valuation. So there are certain workings you have to do, the cost of equity calculation. I think IOSL cost of equity for us to calculate, we have to find out what is your gearing ratio is. Gearing ratio is. So the company, the similar company in the market, they have given you the beta is 0.7886. I think even the pre-scene, I used this similar company beta to calculate beta of the EOSL. But in this case, we are not talking about EOSL, we are going to talk about IOSL. So the comparative company gearing ratio is given 7:5, that is 58% to 42%. And the beta, the risk factor of the company is given at 0.7886. So using this formula from the CAPM model or CAPM area, portfolio management and CAPM knowledge you must be having. Based on that, if you are calculating the beta, IOSL beta going to be 0.46. IOSL beta going to be 0.46. So the IOSL equity to debt ratio, IOSL equity to debt ratio is used 79.77 and 20.2. So how they got that? You can look at it. Pre-scene, your equity capital is 138 million and you are going to take the debt capital as your short-term loan which is 35 million. So using the short-term loan and your equity, you can find out the gearing of the company. 34 and another 38 million, you get roughly the gearing of the company. We have choice either to take the bank overdraft or exclude the bank overdraft. It's an assumption you need to make. Bank overdraft is generally used as a short-term financing, but some companies use the bank overdraft like a permanent capital. That means the company uses the bank overdraft on a regular basis. Without that, they cannot be able to run the company. So that basically shows that you are dependent on the bank overdraft for a longer period. If you are dependent on bank overdraft long period, it is becoming your permanent capital. So it is part of your capital structure. But in this case, IOSL, they have mentioned short-term borrowing. Short-term borrowing is used as long-term debt and they will buy your long-term assets. So they do not talk about bank overdraft. So we make the assumption here bank overdraft is partly used or mainly used for short-term financing. So it's not a part of your capital structure. So on that basis, you are talking about 35 million and another 38 million, another 38 million, which is basically used, at the debt equity. So 20 and 79.775 is the debt equity ratio, which is mainly on the short-term borrowing, and the equity has been considered in calculating debt equity ratio. So when you do the calculation to find out the levered beta of IOSL, it is 0.46. So 0.46 shows that what is the riskiness of IOSL. On using IOSL beta, we can calculate what is the expected return or cost of equity of IOSL. Risk-free rate 10%, market rate 16%, risk premium 6%. So this is a CAPM model. So CAPM model, I am sure everyone knows that cost of equity or expected return, equals to risk-free rate beta market return minus risk-free rate. So as you know that market return or the average market return minus risk-free rate is the risk premium. So when you multiply the beta by the risk premium, you get the risk premium specific to the IOSL. When you multiply the risk premium by beta, you get the risk premium specific to the IOSL company. When you add that risk premium with the risk-free rate, what you get is the expected return or cost of equity. So going backward, so on that basis, risk-free rate is 10%, market rate is 16%, so risk premium is 6%. So when you calculate the CAPM model, the formula what I showed you, required rate of return is 12.76. Or it's the cost of equity of the company. So when you calculate the WACC of the company, stated capital, general reserve, retained earning together 138 million. We looked at the shareholder funds earlier, 138 million, which is 79.775. And short-term borrowing, as I mentioned, the bank overdraft is not considered because the question says that short-term borrowing had been used for buying the long-term assets, which means you are using that as a permanent capital. Bank overdraft is not used as a permanent capital, so we ignore that part of debt capital. So on that basis, short-term borrowing 34.8, so which is 20% and 79% the weightage when you calculate. So the WACC computation you can see here, equity cost 12.76 we calculated using CAPM model, and the debt capital 6.48. Actually, how you have got the 6.48? This is 9% interest cost for the short term borrowing, 9% 1 minus tax rate is 28%. So 9% 1 minus tax of 0.28, you get 6.48. So when you calculate the WACC using weightages of the capital with the cost of capital, you get weighted average cost of capital. So please remember, in your financial management at the case study level question, your WACC calculation, cost of equity calculation have to be 100% you have confidence on that formulas, right? How you calculate, what is the basis you calculate, and especially WACC when you are computing, there are two things to be remember. One is the cost of debt is after tax, not 9%, it's after tax 6.48, and your market values have to be taken. Only thing, the equity and debt capital, if they don't have market value, unlisted company you don't have market value, but if you are given a listed company information, always remember you to use the market values for your WACC computation. In this case, IOS is not a listed company, so we are using the book values to find out the weightage of the equity and debt capital. So on that basis, WACC is 11%. So this is needed in order to calculate the value of equity under free cash flow based valuation. So free cash flow based valuation for us to do, we need the cost of capital, the relevant cost of capital. Since the cash flow what you are going to look at is generally on the case study questions, you would have the free cash flow to the firm cash flows. Since it's firm cash flows, your cost of capital is going to be WACC. So WACC we have calculated by calculating the cost of equity and cost of debt and the weightages, and we have got the WACC 11%. This is the rate you will be using to discount your future cash flow. Then we move on to the free cash flow calculation, right? So free cash flow calculation, when you are going to calculate the free cash flows calculation, you will realize that you have to first get your operational cash flows, In that process, you can see that they have told you the revenue will be normal capacity in next year. Last year, your revenue had been 80% of your capacity. So you need to first convert your 80% capacity, your revenue to 100% capacity. So even the last year figure needs to be normalized. Why? Because of the COVID lockdown, 20% had dropped. So we have to recalculate your sales, which is on a normal capacity, which is 660 million. So 528 million, which is 80% of the sales, 100% sales will be 660 million. But the GB margin is supposed to be 33.5%. So you can calculate your GB margin 221.27, which is 33.5% of 660 million. Then the other income, as in the P&L, what is given, you take the other income 9.9 million. Then the total expenses, you add all the total expenses in the P&L, another 48 million. But there are two adjustments they have given you. In terms of the expenses. You can read out in your selling and distribution expenses for 2021. Selling and distribution expenses reported for 2021 included e-commerce related capital expenditure. So as you know, the capital expenditure is not your operational cash flow, right? It's not an annual thing, first of all. It's not recurrent. Even if you charge it to a first year itself, if you take the operational point of view, it's not an annual cash outflow. So 10 million which had been charged in a P&L should not be taken there. So when you are looking at the future, the 10 million is not necessary, so you can exclude that. Then the impairment charge for trade and other receivable reported will be 1 million. Actually, if you take the pre-scene, the impairment charge of trade and other receivable is 3.8 million. 3.8 million given, but they say the impairment charge is only 1 million, right? Only 1 million. So you need to remove the balance 2.8 million. So you could see that in your total expenses, we remove the selling the capital expenditure what had been incurred for e-commerce 10 million and 2.8 million, which is not the relevant cost. So you remove that. So your actual total expenses are going to be, or the operationally recurrent cost going to be another 35.3 million. Okay. So EBIT we have got 95.8 million and taxes at 26.8 million. So what you get normalized EBIT, which is basically you have adjusted your lockdown period impact and the capital expenditure impact and the impairment impact, you have removed it and you have got normal EBIT 1 minus tax is 69 million. So this is your operational profit, Then moving on. So one operational profit we have calculated, EBIT 1 minus tax, if you will have one item. Then the depreciation they have given you 25 million per annum, very straightforward, they have given 25 million per annum. Anyway, please remember, in order to value IOSL, we are using only 10 years of future cash flows, After that, the terminal value we are going to ignore, So 10-year period only we are looking at the calculation of free cash flows. So therefore, the present value when you are calculating, it's only for 10 years. So you can see the depreciation, annuity factor for 10 years at 11%, which is WACC we got earlier, 5.889. So present value of depreciation is 147.225. Capital expenditure they are given 22 million. Again, annuity factor 5.889. So your present value of capital expenditure 129.55. So this is the present value of two items. Then the working capital. I think the examiner used another method to find out that, right? So we will come to the equity valuation on the normal basis where you generally use 10-year cash flows. So we will take the 10-year cash flows, very easy to put it here, EBIT 1 minus tax. We got 69 million EBIT for last year, normalized EBIT. From there 3% growth for 10-year period. So 3% growth had been taken from there for 10 years, EBIT 1 minus tax. Working capital, you can see that working capital working is here. They said 28.57 million is the last year working capital amount, which is given there. In the pre-scene, if you look at the working capital amount, not previous scene, the unseen, you would see that working capital is given. Working capital requirement currently at 28.57 million. So it is current amount of working capital is 28.57, which will increase by 5% per annum next 10 years. So the working capital investment you are going to make annually is 5% of this. Every year it will go up, so you have to find out how much is going to be that. Year 0, 28.57, that will go up by 5%, so it means 1.43 million is a change in working capital. So every year you can see that the increase in working capital is given in the second row. So this is the amount of working capital you have to invest annually. So your cash outflow going to be only the change in working capital. That is given here, each year how much a capital expenditure, the working capital you are going to invest. Capital expenditure 22 million. Depreciation you are adding back. As you know, the EBIT is a profit number. It's not a cash flow. So free cash flow based valuation we have to find out the cash flow. So what do we do? EBIT as consider depreciation. So we have to add back the depreciation in order to convert that into cash flows. So in order to do that, you are adding back the depreciation 25 million each year. Net cash flows, you have got it, and W is 11%, present value of cash flow 475 million. So this is the present value of free cash flows for a 10-year period. No terminal value is considered because the question had very clearly said you ignore the terminal value. So based on a 10-year cash flow, I told you there are two ways you could do it. The working earlier what they did is little complicated because you are going to take each item one by one. but here it's easy, it's a normal basis you would do 10-year cash flows, EBIT, working capital investment, capital expenditure, add back depreciation and net cash flows, which been discounted at 11% because that's the WACC, and you get the present value of future cash flows 475 million. So we come back here, 475 is your value minus, because your value what you get is including debt capital, so you minus the debt capital 35 million, then what you do is you add back the cash and cash equivalents in order to get the equity value, which is 451 million. So if you remember, the question asks you calculate the value of IOSL and validate. So when you go to validate, the question very clearly said the valuation range is 42 million to 452 million, 42 to 452 million. So I think we got the three methods of valuation earlier. Earning based, net assets based, and the liquidation basis, which is again asset based valuation, but you are taking a full understanding that your company not going to go for going concern, it's going for liquidation. So 112 million, and your free cash flow based valuation 452 million. So on that basis, we have got four values of this company, IOSL. So the question asks you to validate. So we have validated and we have got that values. Okay, we have got the four values. I go to the question here. Validate the price range under four valuation method with necessary assumptions. So we have got the value of the IOSL, income base, net asset basis, and the liquidation basis, and the discounted cash flows or free cash flow method. So as you know, if you are looking at a company as a going concern, more appropriate value would be the 452 million, which is the free cash flow based valuation. Okay, so just keep in mind that we have got four values and we have validated. Used methods are earning method, net asset basis, and liquidation basis, which is again net assets but liquidation basis. Fourth one, your discounted free cash flow method. So four methods we have got the values, and we know that its more appropriate value will be free cash flow based valuation. Then we go to the B part of the question. B part of the question, the examiner asks, management of EOSL needs to help to understand the reason for such a large range in valuation under various methods. Comment on the applicability of each method for the period under review, together with any other company specific that must have contributed towards such a large range in valuation, and determine the best estimated value for the equity shares of IOSL with adequate justification. So we got the four values. Now the 8 marks is given for you to talk about the four methods of valuation, why that values are different, So when you go to the suggested solution, I think while we discussing at the beginning, I mentioned net asset basis will give you the lowest value generally because it does not say the future cash flows are considered or earnings are considered or potential of the company is considered. It simply look at your balance sheet. So net asset basis and the liquidation basis are not suitable methods for any going concern company. So any going concern company, if you are going to buy IOSL to run as a business, I don't think that you should consider these two methods, asset based or liquidation method, because asset based and liquidation based is basically looking at your balance sheet, or it's your liquidation based is actually looking as like you are going to dismantle the company, selling the assets, settling the liability. So anyway, the liquidation base is out. You can't take it for any company unless you are really going to do that. Asset based, again, it does not look at the future. So anybody who is really trying to run a business should always give value based on other methods, not on asset based valuation. But you should know the asset based valuation so that you know that would be kind of a minimum guaranteed value for your company. So if you pay 138 million or above, you know the 130 million, even if you don't run a business, you can realize 138 million by simply selling the assets. So that is the confidence you get by knowing what is asset based valuation is. Income based, in this case, the company would have felt that the income is smaller. income is smaller, that is because the management are not been running properly, because the owner, the main person who is running the company is sick, so he is not contributing to the company for the performance. In the other words, the company was not able to get the full potential of the company. So the earnings are lower at this moment. So if you are going to use the earnings to value this company, it may not be a right value, because it's not reflecting the proper value of this company, because your earnings are not proper. Further, your lockdown also have resulted in a drop in your sales and the earnings. So that is another contributory factor. Your earnings may not be a right earnings of the capacity of your company. So your earning method in this case should not be looked at, because it's not reflecting the proper earnings of the company. So asset base is out, liquidation base is out, income base out, because these are the reasons. GCF method is generally the more comprehensive method, because it looks at the future first, and it looks at cash flows of the company, and it looks at the growth of the company and the potential of the company. So when you look at the comprehensive method like free cash flow, it generally gives you the larger value by looking at the future. And actually you need to be mindful, we have ignored the terminal value. So when you look at the terminal value, still your value could be more than this, because terminal value add on to your 452 million. So the potential of the company could be greater than what you look at this moment. But please remember, always the free cash flow method, the limitation is the assumptions, because you are going on assumptions of the future. You are assuming the revenue going to be growing at 3% from now. So that is the assumption you are making, and you are thinking that your capital expenditure is so much over the next 10-year period, and you are thinking that working capital is going to be so much, I am going to invest every year. So these are the assumptions you are making in the free cash flow based valuation, which may or may not be proper, and your cost of capital is assumed to be 11%. Now see, in Sri Lanka, actually 2021 when you look at the cost of capital was lower in Sri Lanka. That cost of debt is 9% would have been actually reasonable at that point, 2021 December. But today context, if you take the cost of debt, it's not 9%. It's significantly higher. So it's about 20%, So your cost of debt is not 9%. So your WACC what you used at that moment, which 9% cost of debt and after tax 6 point something, and your WACC is 11%, which is very low at that point. So at that point you use 11% and value the company. But today's context, if you go to really look at the same company, same valuation, your value is very much lower, simply because your WACC has increased significantly, because the market interest rates, central bank increased the interest rates, so your cost of debt is not 9%, it will be around 20%. So when you use that 20% as the cost of debt, definitely shareholders want more than that, because their risk aspect is more, the financial risk what they are taking is more. So cost of equity will be definitely more than cost of debt. So in that case, the same company, same question if they ask today, your WACC is going to be very much higher. So when the WACC is going to be very much higher, your present value of future cash flow is going to be lower than what you used to have. So 452 million may not be the value today if you do the same question, because your cash flows, even though cash flow could be same, your cost of capital is very much higher, then the present value will be low. So present value what you get as a valuation, 452 million, will drastically drop because of your cost of capital. So what I emphasize in this question is, the assumption that you make in free cash flow method can be changing over the period, and your value can change. So you need to be mindful. I think the good question it is, because 2021 December and 2022 July, you can see June, you can see the big difference. So that the value 452 million become 200 odd million, because your cost of capital has changed. Your cash flow may not be the same cash flow. Your GP margin would have come down, because in Sri Lanka the inflation is very high today, right? When you look at the cost of sales, would have been very much higher, so GP margin would have come down. In that case, your admin costs, selling expenses also would have gone up. So in that case, your free cash flows, what you expect to be there in 10 years, over the 10-year period, may not be the same, and the growth you may not be able to achieve the 3%. So if you look at all that assumption, validity today may not be relevant. In that case, your value what you calculate at 452 may have changed if you do it on a 1 year later. So what I want to tell you is free cash flow method would be the more comprehensive method of evaluation, but please remember the assumption you make in calculating these values can change drastically over a period of time. So in that case, your value what you establish may be reducing because your future is not that certain as you would have forecasted. Okay. So that's basically these limitations and the things you would have considered. Right. So I think the factors they have given you, but generally the comprehensive method is the free cash flow method. So I would recommend that you consider the free cash flow method as the more relevant method for you to value 450 odd million, but 450 million you don't just give the 450 million as offer value, because you know that there are various assumptions you have made, may or may not be possible. In that case, you need to make adjustments for your value when you are going to look at it. It has its positive sides and negative sides. So the positive side, I would say like your terminal value is not considered. So when you consider that 452 could be more than this, your value could be more than 452. But the negative side of it is your assumptions realistic or not. If your cost of capital is going to change because you are taking a very low cost of capital, but if your cost of capital change like today, if it's changing, then your value will be lower than what you expected. Okay. So that's your B part. So you would have seen that the case study question A and B, 25 marks, both parts were mainly focusing on the valuation chapter, I'm sure like when you learn financial management, the valuation chapter is the key chapter, because there you will learn certain things which are going to show you that your accounting mindset is different to your financial management mindset. So your financial management shift happens in the valuation chapter, because otherwise we think that net asset basis is the company value. So it shows that no, that's not the value, there is something else, and the value is greater when you compare the future of the company. So that is why the valuation chapter, when you learn and properly understood, even the other some of the chapters which are kind of a link to the chapters, which are like for example mergers acquisition, so even the capital structure and the leverages. So many chapters you would see those are linked to your valuation chapter. So if you are confident on your valuation, I am sure like most of the areas in financial management easy to understand. So if you at this moment I want to tell you that theoretically make sure that you are very comfortable with the valuation chapter and understand the logics, why we use, how we use each and every variable in calculating numbers. Rather than just memorizing numbers, like look at the future and see these cash flows are on this assumption. Like what I argue on the earlier part, your WACC based calculation will give you 452 million. But your WACC is going to change over a period of time because the interest rates are going to change. Unless you have taken the loan for a longer period at the same rate. As I mentioned, it's a short term borrowing, only 9%. Short term borrowing means every short period it changes. So 9% become 12%. 15%, now 20 odd percent. So if it is 20 odd percent, your WACC is different. So your value of the company, it will not be 452, it will be half. So you need to be very careful in understanding each and every variable in valuation. So once you are master of that, I think you can play around with your other things. Okay. So be confident and understand the valuation chapter properly. So that will help you. I think the second part, 25 marks today, the case study question, it's about the mergers and acquisition. So you see I think the first time the examiner has given 50 marks question on valuation, mergers and acquisition. Okay, so if the people who have really got this understanding proper, you are going for very high marks, because both topics are kind of linked and your knowledge is easily applicable each and every area, because if you have learned it properly, you know when you read it, you know what you are looking at it. Okay. So going to the question, C part, as the financial consultant of the company, draft a report to the company covering the following areas. So they have given you many areas in respect of proposed 3 target acquisitions. So the board meeting 2 talks about 3 target acquisitions. While we have the IOSL as a target to purchase, we look at another 3 companies also for the company to take over. So that 3 acquisition information is given earlier in the B part, or maybe the board meeting 2. They say you have been briefed that only one company will be shortlisted for comparison with IOSL. So IOSL will be compared with the 3 companies, out of 3 companies you select one and you compare with IUS and decide. So we will have to cover the report in few areas. One is explanation of the synergetic benefits. Synergetic benefits arising from each target acquisition with necessary computation. 6 marks. So each target acquisition we need to find out the synergy. So we will come to that. Second, the price range that EUSL should be willing to offer for each target company for negotiation with appropriate assumption and reasoning. So that is about how much you can give maximum to buy the target company. Third, business implication, any other critical qualitative aspects, though theoretically they are asking you any other qualitative information. Appropriate financing method for each target acquisition. So these are 100% your mergers knowledge, mergers acquisition knowledge. You know that if it is a larger company, you may not be able to buy that company with cash because it is a larger company. So you try to use share issue to buy that company because you don't have enough cash. Even if you are going for debt capital, you need to find out whether your capital structure is going to support you that extra debt. So if you are going to go for high debt capital to buy a large company, your gearing going to be very high. So your financial risk goes up very much. So in that case, you may decide, no, large company I may go with either share issue or mix of share and debt issue rather than purely using the cash or debt. If you are a smaller company, if you are talking about target, you don't mind using your own cash or even to borrow money. So you should know the basic knowledge in your knowledge in a mergers and acquisition, at what point of time I should use cash or the debt capital or equity capital, whether I am going to issue shares and get the money. So that's about these 4 marks. Each target acquisition we will talk about. Conclusion on the selection of the target acquisition to be compared with IUSL. This is the final level where you would compare your different acquisition information with IUSL and decide what is to be done. So these are the parts. 25 marks is given. For the C part, it's simply the mergers and acquisition. Before moving on, I just want to tell you, when you are going to look at merger, right, you need to find out the synergy. So your theory knowledge has to be very clear. Synergy, how do you calculate? You need to find out what is my value of combined entity. What is my value of combined entity? So you need to find out the value of the combined entity after the merger. After the merger, what is the combined entity value? Minus, you need to find out value of A plus value of B. Now these two entities values we take before the merger. Before the merger, each of these company, what is the value on their own? First find out on their own what is the value of these two companies, right, before the merger. This is the value of the combined entity. Once you merge these two companies, they become a larger entity, combined entity, that is after merger. So after merger, what is the value? So you need to find out in order to calculate synergy. This is a theory what I am trying to tell you. Synergy equals to value of combined entity after the merger. This is you have to use to or you have to minus before the merger. What are the merger value? What are the company's value? Value of A, value of B, before the merger how much? When you minus that from the combined entity after the merger, what you see is the synergy. So this is the actually present value of future economic benefits. This is the present value of future economic benefits. Present value of future economic benefits because of the merger. Because as you know that when you merge two companies, you are expecting synergy to take place. It may or may not, but you are expecting synergy to take place. So when you are going for merger, please remember you are expecting the synergy to take place where the both companies resources when you put together, you will see that revenue start increasing, cost of sales start coming down because of your bargaining power and your market share, and negotiations, it will come down your cost of sales. And your admin costs, selling costs also will start coming down when you combine the entity. Why? Admin costs, when you go to use the resources such as human resources, back office staff, even the finance people, when you merge, you don't need the same amount of people. So you can reduce some of the people by which you will save company cost. Further, you will see that location, the buildings you are using, factory premises you are using, or the offices you are using may not be the same amount of space. You can reduce some of the space and reduce the cost of there. And then IT cost, you don't need 2 IT systems, so you could reduce the cost on the IT systems and maintenance cost can be reduced. Then you will see that transportation cost can be reduced, and sometimes you will see that your sales cost like advertising, promotions, some of the promotional material, promotional TV advertisements and activities all can be reduced. When you put together, you don't have to do the same amount of advertising and promotion. So when you do that, you will see that there is a cost reduction. So please remember that when you do merger, your revenue start increasing, cost of sales start coming down, and your costs start coming down. So these all benefits convert into economic benefits annually. Present value of that is the synergy. So that's basically the final outcome when you do merge. So this knowledge has to be very clear to you in your mergers and acquisition. If you are very clear in that, I don't think this question is difficult for you. So the question asks you explanation of the synergetic benefits arising from each target acquisition with necessary computation. Now we go to the board meeting 2. Board meeting 2, they are talking about Herbert has made an initial offer of 200 million for 100% of IOSL shares. Now even though IOSL shares had been valued under 4 methods, 42 million to 452 million, the chairman is offering only 200 million to buy the target company, 200 million to buy the target company. But Rayan's family thinks that offer is too low. So because you know that when you look at a 452 million, 200 million is very low, 50% you are offering, less than 50%. So they are not interested. Herbert has come up with 3 target acquisition that would be good acquisition opportunity for EOSL to consider. So those are 3 companies we are going to look at it, right? In addition to the IOSL, which is anyway available, where the offer has not been agreed upon, but we are looking at the now 3 companies. So you can see that first one, it's about New Tech, it's about a printing station company. Then the shareholders seems to struggle to replace the board of directors due to the technical nature of the business and the strong relationship with the customer. So this is a specific aspect of this company, New Tech. The corporate bank of EOSL has expressed willingness to provide a long-term loan to cover 60% of purchase consideration at a consideration interest rate of 5% with the condition that all banking needs of the EOSL group carried out only with them. So this is about first target company. They are talking about, it's about a printing company, and the board of directors of the New Tech is by the shareholder. The question had been raised because they are referring their existing customers to a newly incorporated competitor. So please understand, the company directors are referring the company customers to a new competitor. So definitely there is a doubt why they should do that. Because you are the director, you will try to get the business to your company, but you are sending your customers to another company. So that means you may have a plan that to shift your resign from your board and go and join that company, and you become the owner of the company and all your customers are with you. So that is something a concern already the shareholders has worried about. And then bank loan had been given for the funding, so we will come to that. Second company, TSS, is specialized in importation of wide range of printing machines, spare parts, and it has island-wide distribution, its own channels. Market perception is that TSS shares are undervalued currently, as the benchmark company prices remain low due to the current economic conditions. It's a good buy. It's a good buy. Background checks discover that 1/3 of company shares are held by a well-known family in the country, and they have already defeated 2 hostile takeover attempts in the recent past. So this is a company where they have good distribution and the shares values are lower, but the shareholders are 1/3 of the shares are held by one family and they are trying to avoid the takeover threat of anybody. A young management team currently runs the business. According to staff, recognition and benefits are purely based on performance. This is the second company for us to look at. Third company, WST provides finance and accounting outsourcing. It's an outsourcing company to Europe and Australia and US. Company incorporated 15 years ago, small entity, it's a small company. 2 main shareholders own 100% of the company and they are retiring. Retirement is coming, so they are trying to move into the real estate business. So these are the information. Then they give you numbers. Number of shares in issue, 19 million. Market price, 27 per share. Dividend per share is given. Debt percentage is given out of the equity. Forecasted growth rate 4%. Required rate of return 13.5. So when you look at dividend per share, growth rate, required rate of return, what is your mind going to tell? What is the method of valuation you may use? When you know the dividend per share, when you know the growth rate, when you know the required rate of return, you can calculate market value of the company using dividend growth model. So this information is supporting us to calculate the market value under dividend growth model. Keep that in mind. Anyway, they have given you the market price, assume market price, they have given a note there. Assume market price has been calculated based on similar listed company in the market from the Colombo Stock Exchange. No similar company were found for the WST. Out of 3 company, 1 company they don't have a similar company, but other 2 companies they have given you a market price, similar price in the listed market. So you can calculate market capitalization of the company based on the market price, one way. Second, you can use the dividend growth model to calculate the market value, second way. Then go into TSS, same information is available. Third, WST is given, only thing they don't have a market price, but actually you have been given a dividend basis valuation or the method you can use because you have been given information. Then, what is important here, they have given you the NPV analysis. EOSL group only value, they are given 2,500 million. So EOSL only, that is the group we talked about on the pre-scene, a lengthy, they are given you the group value 2,500. You don't have to do anything on that company. They are given you the value. EOSL group with the proposed entity, 1 New Tech, 1 TSS, 1 WST and our EOSL what you talked about in the A part. So with that EOSL group with the proposed entity, your value is given here. Value creation they are given here. Now please remember, when you know the EOSL company value and the EOSL and the proposed entity value, you get the total value. So EOSL company and the proposed entity value when you add, you get the total value. So when you minus the EOSL, you get the 1091. Now 1091 is, they say, value creation. That is because they say because of new tech you are going to take over, your value going to go up, that is EOSL value will go up by 1091. Now we need to remember, as I mentioned under my synergy calculation, combined entity value equals value of A, value of B and the synergy. So value of A is here, 2,500. Value of A and value of B is here. So value of AB minus value of A, you get what? Value of B plus the synergy. Not the synergy. Don't think that this is the synergy. This is the value, you get value of A, value of B and the synergy together is this value. Value of A is given to us. We are not given value of B. So we should know that this value includes value of B and the synergy. So this, all the value what is given includes value of respective company on their own plus the synergy. Please remember that. I think there could be some people thinking that this is the synergy, this is the synergy. Then what about the B value? What happened to new tech value? What happened to TSS value? It's not there. So you are thinking entire tech value is the synergy. It can't be. Your tech has its own value. So remove the tech value, then automatically you get a synergy. Okay. So they have given you this valuation. Now go to the C part question. As a financial consultant of the company, draft a report to the chairman covering the following areas in respect to the proposed 3 acquisitions. You have been briefed that only one company will be shortlisted for comparison with the IUSL. Explanation of the synergy benefits arising from each target acquisition with necessary computation. So you have to calculate the synergy. You have to calculate the synergy. So we go to the calculation. So as I mentioned, the first one, so these are the 3 acquisition with the IUSL, including EUSL value is given. So 1091 is the EUSL group and the new tech. When you combine, apart from EUSL group value, you get 1091. So as I mentioned, 1091 is not the synergy. 1091 is not the synergy. So we are talking about value of combined entity. That value is given there. You have to minus value of A and B. Both you have to minus to get the synergy. Only value of A is given 2500. So you minus value of A 2500. Then what you get? Value of B plus synergy, both together. So we need to know that 1091 includes synergy plus the other target company value. So we need to find out the target company value. I think the suggested answer, if you go to you can see the value. Market price, as I mentioned, number of shares are given, market price is given, market capitalization you can calculate. You can simply multiply the number of shares by market price, you get market capitalization. Very straightforward. Number of shares into market price gives you market capitalization. Please remember, the market price is given for a similar listed company. Only the third company we don't have market price, so we can't get the market capitalization. Otherwise we can get the market capitalization. Second, we are using a dividend growth model to value the target company. So as I mentioned, you have been given the current year dividend and the growth rate, then you can calculate next year dividend, required rate of return, and calculate the valuation. So your valuation is giving you 540. Here you can't use the TSS, you can't use because your R minus G. G is growth rate 14.2, R is 14%. So as you know, under dividend growth model in your theory, if you have learned properly, R minus G, R has to be always more than G. R has to be more than G. If the R is less than G, you cannot use dividend growth model to calculate the value. On that basis, this TSS company, you can't use dividend growth model because your R minus G is minus, so which is not relevant for us to calculate the value. But new tech, we have got the value, WST, we have got the value. So please remember that we have used dividend growth model, we have used the dividend growth model to calculate the value. Now going to the discussion. So your new tech, the additional value is 1091. Out of 1091, we know there is synergy and the target company value. So target company value, you have two values. One is the market capitalization and the dividend growth value. So we can use one of the value. So when you take the 1091 minus 540, the balance amount comes to the synergy. Now the question is, how much I am going to offer? If I say the entire synergy I am going to pay for, I will be paying 1091. But I should not be giving 1091, I should be giving lesser than that. You should be giving lesser than that because you will have to get benefit of the synergy to your company also. So you will give maximum 1091 not 1091. You don't give 1091, the maximum you can go to 1091. So you should start with 513 million or 540 million, right? So you start with your 540 million, it's a market based valuation, dividend growth model, 540. So from the starting point 540, you go up to 1091. So that's basically the synergetic benefit you have. Synergetic benefit is the difference between 1091 and the 540, right? 1091 includes the target company value plus the synergy. So you remove the target company value, which is 540, then we got the balance as a synergy value. Okay, so I think the price range, the suggested answer says that you could give 30 to 35% premium. That is actually going on a negotiation. You start with the lowest value, right? Slowly you start, and while negotiating, you will add on the price and then come to a point and you stop, right? Your maximum is 1091, but you will in between you finish. So the suggested answer basically discusses the range. You can see the range. Suggest the price range between 30 to 35 rupees. So you can negotiate in between that value. Okay. Then the business implication. They have said the existing directors are sending the customers to the competitor. Existing directors are sending customers to the competitor. So immediately you need to know that why they are doing that. Why they are doing that. Because once you identify there is something wrong happening, you should not go and buy this company, because once you buy the company, if all the customers start moving to the competitor, you may not be able to run the business in that company. That means the value that you are paying will be a loss to you. So you should keep in mind that and decide whether I should pay the value and then buy the company. So that's basically this discussion. If your management is confident about your business, you may be buying, even paying a value for the target company. Financing method, as I mentioned at the pre-discussion earlier, the financing method, you have been given a 60% purchase consideration you can use by a loan at a very attractive rate of 5%. So you have to look at whether it's possible for you to use to buy the company using the loan, which is going to be at a concession rate. So that's basically it's good that you are going to get a lower rate, so you buy the company at a lower cost of funding, So that's basically your first company discussion. Second one, synergetic benefit. Same basis, same way. 2021 is the EUSL group with the TSS. So when you both together consider 2021, it includes TSS value and the synergy. Now we have to find out how much is the TSS value. Here. So TSS value, as I told you, under market capitalization, TSS value is 1398 million. Out of 2021 value, TSS alone 1398 million worth. So the gap only synergy. Valuation of under dividend growth model we can't apply because your R is less than G. So recurrent rate of return is lower than growth rate, so we can't use the dividend growth model. So we have to depend on market capitalization, which is 1398. So when you take that, you can see that 2021 is the TSS company value plus the synergy. 1398 is the TSS value. So the gap between that is 623 million, which is a synergy. So synergy can be 623 million. So what is the price you are going to offer? Maximum price you should offer is 2021. But you should start with 1398 up to 2021. So you should have a price range in between. So the examiner or the suggested answer says that you give 30 to 35% margin or the premium to buy the target company. So you start with 1398 with a 30% margin or premium and you start your negotiation. Maximum you should pay 2091. So that's your target pricing. Then the business implication, already we have identified this company, 1/3 had been owned by a reputed family in the market. So they don't want anybody to take over this company. So they are resisting the last 2 hostile takeover attempts. So they can do the same thing for us. Same thing can be done for us. So we need to be convincing the target company shareholders by giving a good price for the shareholding. If you give the right price, they may be considering our offer. So it may be only a try you can do. So that's basically discussed here. Always remember, the TSS considered to be an open corporate culture and good governance, whereas the USL has been established I family. So you need to understand that the culture differences, any merger acquisition could fail. Merger acquisition could fail if the cultural differences are very high. If you see that 2 different cultures are in the 2 organizations, it may not be possible to the merger to be successful. So that is something they are looking at or discussing in this point. Financing method, 1.8 billion is the value. So earlier calculated with the 30% margin, 30% premium, 1.5 billion or 1.8 billion is the target value. 1.8 billion is not a small amount. It's a large amount. So it will not be possible for you to use the current liquidity. And even to use the debt capital, it can be resulting in a very high gearing. I mentioned in the earlier theory discussion, you can result in a very high gearing, so it may not be possible to use the 1.8 billion loan capital. Third one is the WST company. Similar approach. In the event WST acquired, it's 396 million to the group's NPV valuation. But when you go on the standalone basis, when you calculate on a dividend growth model, the value is 165 million. So 165 million is the target company value, but with the synergy it comes to 396. So the synergy is 231 million. Same basis. So 231 million is synergy. So maximum offer you should give 396 million. So price range, they are giving you, start from 165 million, that's the target company value, up to 396 you can negotiate and go. Maximum 396 you can offer. So they are given a range again with the 15 to 20% margin or a premium, you can go up to 190 to 198 million. Business implication, it's outsourced company. So it's good that you are getting into outsourcing company, because then you are going to diversify. And the portfolio theory, you would have learned that much as possible diversify your business, that will reduce your risk. Right, so diversification is something every company, even the country, should be looking at. I think one of the key reasons we were failed in Sri Lanka at this moment is the tourism failed. Right, we have lost huge amount of dollars. Right, the tourism is one area we have been depending too much. Right, that's not there, then we lose the entire foreign currency earnings. So if you are diversifying into various sectors to bring dollars, you may be able to sustain, even in difficulties you can sustain. So that is something, the portfolio theory we should learn properly and understand. Anywhere, try much as possible to diversify. Even if you have 10 million rupees, you want to deposit your money. You might see that in today's context, there are enough institutions are offering high interest rates, right? 18%, 19%, 21%. Finance companies are offering 23%. So you might be attracted by the rates, and then you might say 10 million I have got, I am going to invest the 10 million in one basket, one bank or one finance company. Don't do that. Portfolio theory, basically it says put all your money into different basket. Don't put all money in one basket. So try to put all the monies different baskets so that your risk is diversified. So don't depend in one investment category. Don't put everything in deposits. Put your money in different instruments. Right? Don't put all the money in one institution. Try to put it in many institutions. So you please understand that is called diversification under portfolio theory. So same thing here. The third company only has the opportunity of diversifying your business nature. So it's something you can look at it. Anyway, your value, what you are talking is smaller. So it's easy for you to buy. So you can see that the raising funds will not be difficult for this company because the value is smaller. So even if you find debt money, it's not a problem because you can borrow money and invest. because it's a small company. So this is basically the third company we are talking about. Then we are comparing the four values. So when you look at the four values, I think the one company we said it's not possible. It's a second company, 1.8 billion. It's not possible, we can't fund it. So it's out, TSS is out. WST is very much attractive. Even we looked at it from the value. And outsourcing, it's diversifying our business nature. And you can see the synergy as a percentage of market capitalization is 122%. So WST is more recommended value or company to be bought over, looking at many consideration, and financing is also easier. IOSL, looking at it when you compare with WST is more attractive. But if you are able to reduce the IOSL price, if the Rayans family agree to reduce the price, you might be able to bring it to a lower price, but still it's very difficult because 194 million it won't come. Right? In case they come to closer to this, IOSL could be attractive. Otherwise, WST is attractive for your company to buy. So these are discussion you could see in that. So what you have to understand, this is a very good question on acquisition and mergers, or mergers and acquisition, and the valuation chapter. So this case study, even though we have a large pre-scene discussion, but when it comes to the merger and acquisition, straightforward, the numbers are given in unseen material and the questions have been asked. Pre-scene level information used only the IOSL acquisition. So that we discuss on the valuation chapter. IOSL value has been calculated based on the pre-scene, but the second part of the mergers and acquisition is purely on the unseen material. So what I want to tell you is, please remember the valuation chapter is very important chapter. If you can, make sure that you are very clear, especially the cash flow based valuation. All the variables involved, how the variable can affect your value, how the calculation of present value can affect it because of your variable changes. All have to be known very clearly. That will be helpful. Then the mergers and acquisition, you need to be very clear on the synergy. As I mentioned, synergy is this. This is the synergy calculation. So you need to be very careful in the synergy understanding. It's not the other company value. The synergy is A company, B company value on their own before the merger. When you minus it from the combined entity, what you get is the synergy. The gap between the combined entity and the two company value before the merger is the synergy. So with that, you need to be clear in your valuation. And the dividend growth model has been tested in the question. So a lot of valuation merger acquisition knowledge has been tested. So if you are very thorough with your knowledge, I don't think anyone will have difficulty in getting the marks in this question. Okay, thank you.